Tejas Gutka of Tata Mutual Fund is here with me to talk more about that. Tejas, afternoon.
Good
How
afternoon.
are you really analyzing the valuations of the broader markets, Tejas, given the fact that it was a more stealth correction which was happening in the broader markets, mid and small, for last many months now? Indices may have masked that to a large extent. But broader market on average 30, 40, 50%, depending on what stock are we talking about, has already corrected. Has bottom formation started there? Is value emerging?
Value is emerging in some pockets, but I think when you look at the cohort of broader markets as a whole, it still seems that the mid cap space especially looks like that it's still not come into the value zone. There are pockets of value, but definitely not the entire mid cap space. Small caps relatively look better compared to mid caps today when you look at valuations. But the difference between the valuations of let's say mid cap to large cap, that difference is very narrow today, and which is why we are slightly cautious on this segment despite the price corrections that we've seen.
I have observed that you have been buyer of some of the auto ancillary names in the broader market. Uh, what kind of triggers do you see? Are earnings growth very good? Valuations have come down. What is giving you comfort in select auto ancillary purchases which you have made actually?
So it's a combination of factors, right? There are some stocks where the earnings growth is very strong, and the stocks haven't done anything for a year and a half, which means valuations that had gotten a little expensive have come off. There are some which are domestic cyclical plays where we think that as the cycle turns, the earnings of these companies will see a sharp turnaround. Some of them have been ignored names, and therefore valuations are very comfortable. And then there is a pocket where the earnings have been stagnant for the last 4 5 years. These are global auto plays. The global auto market has largely been flat from a point to point perspective over the last 4 5 years, and we're seeing signs of that improving as the semiconductor supply chains improve. Valuations obviously have come off because you've had 5 years of no movement in stock prices. So we think that even a normalization of earnings here over the next 2 3 years can create significant alpha opportunities, and that's why we've invested in these three different kind of auto ancillary plays.
Tejas, what are the macro worries which could really derail the earnings growth story? Do you think that this entire matter of higher for longer issue can get prolonged? Flows may remain challenging, all of that, because there was a hypothesis that things are turning for real. That seemed to have gotten challenged once again in the last 1 week or so.
Yes, absolutely. When it comes to macro, it's very difficult to kind of build a reasonably a solid view here. But I think when you look at data points, there is indeed some worry, right? So, for example, when you talk to corporates, there's a lot of feedback that post the festive season footfalls have started coming off on the consumer side of businesses, not necessarily staples or durables, but for every business that is consumer facing, we've had a feedback that one way or the other there is some slowdown on the ground, right? We saw that in the GDP numbers that came off yesterday or the day before yesterday, where private consumption expenditure has really come off. So it seems that inflation is starting to hurt some amount of consumption. At a time when rural was already slow, we are now seeing even urban consumption kind of starting to slow down a little. So that definitely is a sign of worry. I don't think you could say that for the entire economy. There are pockets that are doing very well, right? So look at travel and tourism, hotels, airlines. These, the numbers here are fantastic. So it seems that the nature of spending is changing, where people are being slightly cautious on some segments. Let's say the discretionary segment, but travel, leisure, these kind of segments continue to do very well. So it's mixed signals so far, but yeah, I mean these signals are strong enough for you to kind of pay attention to them and at least monitor them over the next few months.
Tejas, the portfolio which you're holding, after the third quarter numbers, how did you scan through the earnings quality? What what are the worries which you saw, or other managements you're speaking to of your portfolio company able to manage decent growth, or do you think there is some amount of shadow at the horizon in terms of the earnings growth for next 4 quarters?
Yeah, it seems that there is some amount of shadow at the horizon, at least in a few sectors. When you look at the earnings growth of this quarter as well, right? While the headline numbers look very, very good, I think the top line grew at an aggregate basis about 15, 17%. But the challenge is really EBITDA and bottom lines, right? These have grown slower than the top line. And then if you ignore a couple of sectors like banking, the bottom line growth has actually not come through. There's been a slight degrowth on the bottom line front. So there seems to be challenge now. Incrementally for from here on, like I said, demand seems to be slowing a little. So maybe the top line challenges will come through. Margin challenges may not come through because commodities have come off, and therefore you may have some amount of margin expansion. But definitely, it looks like that there is a period where maybe there is a question mark on the earnings growth, the high teens earnings growth that's being built by the market. And I think that's getting reflected in the indexes as well, right? We've seen a fairly elongated period of flat indices. The market is also telling you that it's looking for directions. It's saying that data is mixed right now, and it's not able to decide which way to go through. So there's not a very sharp correction, and at the same time, it's not moving higher as well, right? We've been in a flattish market for a very long time.
How are the flows, Tejas? Because we've seen that the last year when FII were big sellers, domestics, both via PMS as well as mutual funds and individual portfolios as well, kind of cushioned that fall. Do you think that that flows from the retail side of the market are also at risk this time around because they've seen last few months of no return, so they usually chase return, right? So that is also a risk we should be cognizant of.
So there are a few things here, right? A, when you look at the SIP book, that's very strong and it shows month on month improvement, right? So we were at 10, 11,000, we are now at 14, 15,000. So that there's a fairly strong SIP book that continues to cushion the market. But the lump sum flows is where I think the challenges have already started to come through. So despite a 14, 15,000 crore kind of an SIP flow, the aggregate flows have fallen, which means that on a lump sum basis there are redemptions. Historically we've seen investor behavior, like you said, that there is some amount of return chasing that happens. Now you've had 1.5 year of no returns from the market. On the other hand, fixed income yields have moved up, so there is some amount of attractiveness that fixed income starts to offer from here on. So I think fatigue in equity, some amount of attractiveness in fixed income space, this will create some amount of tug of war for flows to equities, some of which I think is already being reflected in the lump sum redemptions that we've seen, and this remains a challenge for the market over the next 6-8 months, because like you said, we've absorbed a large part of the FII selling because domestic flows were were very strong. Now, if those become slower and you don't have support from FIs as well, then there is some challenge for the market that lies ahead.
I was seeing that many of your portfolios are quite tilted in favor of private banks, large private banks. And there's a sense emerging that March quarter onwards, in fact, March quarter could see peak of profitability in many of the banking names. What are your thoughts on the trajectory of or growth of earnings from the banking space?
So maybe March quarter, or maybe in a couple of quarters, we will see the peak NIM expansion, so to say. But that's not really a worry, because it's not that after that there's going to be a very sharp contraction in NIMs. It's just that the expansion stops there, and you'll probably see a more steady state growth in earnings there. Now this is a sector where credit growth is close to mid-teens. There is stability in NIMs that will come through, and asset quality, there are no issues. So bottom line should follow top line growth, right? So sector that can do about a mid-teen kind of an earnings growth. It's a sector, despite all the run-up that we've seen, is still at long-term averages or slightly below long-term average valuations, where the entire market today is above average valuation. So you're getting index kind of growth in earnings with much lower valuations than the index, and which is why we think that this sector continues to be very attractive for us as investors, and these continue to be top weights in most of our portfolios. I think the distinction is less between private and public, but more, in my mind, between the structural banks that have done very well over the last 10 years, and some of the banks where you had cyclical challenges, and now those cyclical challenges have gone away and you're seeing a recovery in those banks. So it's less to do with private or public. I think what you see on the screen is all, there are some public names in the portfolio, but it's more to do with structural versus cyclical allocations here.
All right, Tejas, we'll let you go on that one. Thanks so much for joining us today with your thoughts on market. Take a short break, but